It's Sunday, December 6th. Welcome to a new episode of Bazaar. I'm your host, Sid, and joining us today is Rishabh Khanna. It's good to have you, buddy.
Hey, I said thank you for again inviting me to your podcast.
People might have noticed that whenever we have an IPO, I did an episode with Rishabh on UTI AMC's IPO as well. So he is the in-house IPO guy. So whenever there is an IPO going on and it's coming, so Rishabh is my go-to person. So this week it's going to be all things Burger King. We will take a final look at what's being considered as the fastest growing QSR chain in India. We'll also take a look whether the hype is real or not, and we will analyze the long term potential of the company through several parameters like competitive advantage, growth of the company, and the industry, where the QSR industry is going, and the fierce competition that the company faces. And we'll also touch upon the financials and the valuations of Burger King India. This is one of the best times to come out with an IPO because the markets are hitting all time highs. Sensex, Nifty at all time highs right now. We're running high on greed, and Burger King was no exception. The issue was oversubscribed by 156 times, and people are clamoring over to get a piece of the company. The size of the IPO is around 810 crores, out of which 360 crores would be offer for sale, which basically means that money is not going to be used by the company. It's basically the promoters selling their own stake in the company, and the rest of the money is a fresh issue around 450 crores, which will be utilized to pay off debts and to expand the store count. So Rishabh, tell us something about the objects of the issue and what do you think of it?
Yes, Sid, as you have rightly pointed out, it is an 810 crore issue which has an offer for sale as well as fresh equity of shares. Now, the offer for sale is just for the promoters to reduce the shareholding and to cash out on their investments, while the fresh equity is going to be utilized partly because the company has a commitment to open 700 stores by 2026, so they need to open more stores. They are using it to pay off their debt, and the remaining portion is going to be used for general corporate expenses. Now, if given a chance, I would like to touch upon the history of the company. So Burger King has quite an interesting history. It was kind of started in the year 1953, and it was known as Insta Burger. So
Hmm.
there were two people who kind of saw the success of McDonald's and wanted to replicate it. So they started a chain known as Insta Burger. In the year 1959, Burger King Corporation was incorporated. So the name Burger King that we know today was incorporated in the year 1959. After that, the company was again sold in the year 1967, this time to a company known as Pillsbury. This is a company which I think so a lot of people would be aware of. They sell flour, wheat in India. So this
Hmm.
was taken over by Pillsbury, after which the ownership again changed hands in the year 1988 and in the year 2002. And if you think that is the end of the change of ownership, no, it is not. The ownership of the company again changed hand in the year 2010. This was due to the financial crisis which kind of impacted the company, and the company had to be delisted from the stock exchange, and the company that we know today was incorporated in the year 2013. So coming back to the Burger King India. So Burger King India as an entity was formed in the year 2013, from which they have started their operations in the year 2014, and they have a lot of number of stores which we would be covering in the subsequent topic.
So a lot of change of hands over the years, and not a single promoter that the company has had, for a stretch of time. So that's a interesting thing to know. But over here, we're talking about Burger King India, which is a pure franchisee of Burger King Corporation. And the promoter of Burger King India is actually QSR Asia, which is the holding company of Burger King India. And to just give you a brief, Burger King India operates on a pure franchise model. Okay, it has the exclusive rights to develop, operate, and franchise Burger King stores. And as per the franchisee agreement, they have to pay some royalty as a percentage of sales, and they also have to pay a one-time store opening fees to the corporation. But what they get in return is the brand value of Burger King, which has an amazing recall. Burger King is one of the largest fast food chains all over the world. So that's just a brief about the company, and let's start with the parameters. Let's start unraveling the company one by one. So what do you think is the competitive advantage of Burger King that it has over its peers?
So, Siddharth, the biggest advantage that the company has is the brand in itself. As you said, it is an established player in the QSR industry. In fact, it has branches in addition to more than 18,500 worldwide. Now, as I said, in the QSR industry is a fiercely competitive industry. Companies have to invest a lot in R&D capabilities, come up with innovative products, have to maintain their supply chain, invest in marketing and advertising. And being an established player helps the company adopt best practices implemented at different locations, and that can be replicated in India. So the competitive advantage that the company has is the brand in itself.
Hmm. And also, I think, any innovation that happens abroad by Burger King US could very well trickle down and benefit the franchisees that are operating in India. The Indian franchise of Burger King could directly benefit from any innovation, any changes in menu that happens. And I'll give you an example. If you remember, Burger King had partnered with a plant-based meat company called Impossible Foods, and they had released some sort of a very innovative product called Impossible Whopper. And this plant-based meat burger had generated a lot of excitement. I remember people were clamoring over it. The product was out of stock within a few days, and people wanted to grab a piece of it. And I'm not sure why they did not bring this product in India. They didn't even launch it in India, but I think because Indians are not very familiar with the concept of plant-based meat yet. So this is what really could benefit Burger King India in the long run. Any innovation that happens, like the Impossible Whopper, they could very easily capitalize on the developments made abroad, and they would not need to spend on the R&D at all. That expenditure is just gone away. So I think that's also
Exactly,
a
exactly.
very good competitive advantage, and this is something which other franchisees also have. So it's not a one way thing. McDonald's, Domino's, all of these franchisees actually have that competitive advantage. And moving on to our second parameter, which is growth of the company and of the industry as a whole. What do you think about that? What do you think about the growth of the QSR industry, and how much of that could be capitalized by Burger King India?
So, Siddharth, if you see, the Indian QSR market has a lot of established players. We have McDonald's, we have Subway, we have Burger King, we have Domino's, we have Yum Food brands. So, the main reason why these major food chain enter into the Indian market is the growth opportunities. Now, if you see, what are these companies looking after? The major plus point that India has is, as we all know, we rank number two in the population. Our median age is 29 years. These
Hmm.
companies cater to these kind of millennial generations, or you'll say people in the age bracket of 20 to 40, because they are mainly their target customers. Urbanization has increased in India. With urbanization, people bring in change in food preferences. So that kind of helps these companies to develop their market base there. People would not prefer to kind of have a home cooked meal, and they'll prefer they order or they opt for dine in. The third reason is the increasable disposable income. With an increasing disposable income, people would like to spend on these kind of services. People would like to go and spend out. Now, just to give you a background of the Indian food services market, the Indian food services market is around 4,236 billion rupees. Now, if you see, the major market share is with the unorganized players. These
Hmm.
unorganized players are the street vendors, are people who are not a part of a change. They are just where you go and have food on the street. So they have the majority market share, which is more than 50%. And the market share that we are supposed to talk for this discussion is the QSR chain market share, which is just 188 billion rupees. 188 billion rupees out of
Which is
4,236 billion.
negligible, like, which is negligible actually.
Exactly. It looks negligible, but in the future, the growth rate assigned to these chains is very high as compared to the unorganized market. So the growth opportunities in the Indian food market is tremendous for these QSR chains.
Definitely, and I think that's why all these foreign brands are throwing money in India, because they want to capture that piece of growth in India. Because I think US is already saturated. The growth there is limited. China itself, companies have already invested a lot. It has grown. So the next wave of growth that's going to come in the food industry, it's probably going to be in India. And I think these companies, not only Burger King, but McDonald's and every other big food company out there, they want to grab a piece of that market share. So I definitely agree. QSR industry in the future does look very bright. And if we focus on Burger King India, I think growth is already mandatory for them, because as you mentioned, in the franchisee agreement, they need to open 700 stores by 2026. Uh, I think that's a bit tough, isn't it? Like, given the COVID situation.
Exactly. Exactly, from the current store count of around 260 to go to 700. That kind of a huge ask.
So, on an average, I think they need to open 70 odd stores every year, which is, it means there is implicit growth factored in the company. And the more stores you open, the more money comes in. But it's a double edged sword, because the more stores you open, the more capital expenditure you need to spend. And we'll talk about it later in the financial segment. But it's a double edged sword, and it could hurt Burger King in India going forward, because they don't have the best of balance sheets to go on a store opening spree. And that is something that they need to be careful about. And one of the key metrics to measure growth of a QSR chain is the same store sales. So same store sales is measured for those stores which have been operational for more than 1 year. And Burger King's same store sale in 2019 was a staggering 29%, compared to Westlife, which manages McDonald's. Westlife's same store sales was 17%. However, you need to keep in mind that Westlife has a lot of stores, and the more stores you have, the harder it is to maintain a higher same store sales. So it remains to be seen if Burger King India can maintain such a high same store sales numbers even after continuous store expansion. And like you spoke about the food services market, there's no doubt that organized sector will continue to chip away at the unorganized sector. Because I think, let me ask you a question. If you were given a choice to, after COVID, like after things open up, there's a street vendor and then there's a QSR chain, where would you eat your food?
So this is one of the positive benefits of COVID that has happened with these QSR companies. People will be conscious about their hygiene, so they would likely be focus shifting from these unorganized players to these organized chains, which can guarantee their hygiene and safety for the consumer.
And I think that food delivery is also one of the main reasons why these chains are growing at such a breakneck speed. Because with Zomato and Swiggy, it becomes very easy to just open your mobile, open an app, and then it's just one click away. So again, one of the biggest beneficiaries of this rise in food delivery is the organized market. And I think they're going to continue to grow. And the biggest beneficiary, it remains to see whether Burger King can capture most of that benefit. I think we will discuss that in our next segment, that Domino's is very well positioned, but as an industry, QSR looks very bright. So moving on, our next parameter is competition. And I'm sure that you have a lot to say about this.
Yes, I do. So, as I said, the Indian QSR industry is fiercely competitive. So, currently, Domino's, that is Jubilant Foodworks, leads the way in terms of store count as well as the market share by revenue. This is then followed by McDonald's, which has Westlife Development. Then we have KFC. Then comes Burger King. Right now, Burger King lags behind Domino's, Subway, KFC, and this is just a part of the market. There are other players in the market which are not categorized. So the Indian QSR industry is quite segmented. And even if you look at the sector wise allocation, these QSR players normally open their stores in the metro cities. Most of the concentration are in these geographical locations. Now, if you see at the Indian QSR industry, major stores are open in the northern part of the country, barring
Hmm.
the exception of KFC. So what they are doing is they're competing for the same piece of the pie, barring KFC, which has major concentration in the southern part of the country. Another
Hmm.
part that I like to focus on is the QSR industries have to invest a lot in advertisement and brand recall. So that is the main driver which motivates the consumer to come and buy their product. Now, going back into history, I'll kind of say an ad campaign of Domino's, 30 minutes nahi to free. That was such a successful campaign. So actually, after running the campaign, the company was able to break even in profit for the first time in the year 2006. So that was the
Hmm.
power of this campaign. We'll also be able to recognize McDonald's has their happy meals, their value price menu. They were the ones who kind of brought 20 rupees burger. We used to have Makalu Tikki at 20 rupees.
Hmm.
So these players have been in the Indian QSR industry since a long time. Jubilant and McDonald's were have entered in the Indian market since 1995 and 1996. So they have had an extremely major head start as compared to Burger King. Another thing which has been brought about in this COVID situation is the technology advantage that these companies have. As we already discussed, the COVID situation has had an impact. The restaurants cannot have dine-in facilities. So this technology, they people being able to order through their apps, people being able to order through Swiggy, Zomato, or any other food aggregator, has become a very important source of revenue for these companies. Now,
Hmm.
Jubilant and McDonald's have had a head start. They have their own apps running. People are used to their apps and ordering. Burger King has not had that advantage. So this is where these two companies also have a technology advantage over, say, Burger King. Another point that I would like to focus on is the fixed mandate of opening 700 restaurants. The company currently has close to 260 restaurants functioning, and they have a target to open 700 restaurants by 2026. They have to mandatorily open these restaurants. Now, in the Indian QSR industry, what happens is locations are open, branches are open, but it takes time to be profitable. Just to take an example of Jubilant, as recent as last quarter, they have decided to close 100 unprofitable stores.
Wow.
So you may open locations, but it takes time to get profitable. So they have kind of kept a benchmark that if the location is not profitable within 3 years, they'll kind of take a call whether the location has to be closed down or not. One task is to open the locations, the other task is to make the locations profitable, which Burger King till date has not been able to do. We'll discuss it in the financials part. But even if a company like Jubilant takes time, they'll have to close locations, Burger King will also face the same problem. Then another point that I like to highlight is the break even time that is required by these QSR players. Just as I gave you an example, Jubilant entered the Indian market in the year 1996, but they started earning profits in the year 2006. Westlife
In
Development, which handles the franchisee for the western and the southern region, they are still grappling with the problem of profitability. So they are not able to continuously deliver profits.
Hmm.
So these established players have found it difficult to maintain profitability. Another example that I would like to give is of Dunkin' Donuts. So Dunkin' Donuts is a brand which is owned by Jubilant. They are responsible for the franchisee network in India. Dunkin' Donuts took a time of 6 years. They had launched in 2013. They broke even in the year 2019. And how did they break even? They had to reduce their number of locations. So currently they operate in around 32 locations pan India. So that is how they were able to break even. So profitable growth is difficult to find in the Indian QSR industry. Another point that you had highlighted was on the same store sales growth. Burger King had a same store sales growth of 29%, but they also had a low base. They are bound to deliver such a growth percentage. Compare that with Jubilant, which is already an established player. Compare that with Westlife Development, who have around 300 locations pan India. They are still able to deliver close to 15-16%, and Burger King delivers 30% because their scale is less. So
Hmm.
same store sales growth will hit a plateau, and then it is up to the company how do they handle and kind of motivate the consumer to come back and buy products from them.
Definitely, because I think that, compared to its peers, Burger King has to do a lot of hard work. It has to grind each store out because, like you mentioned, it's not easy to make every store profitable. And reaching that 700 landmark store count is it's not going to be easy for Burger King. So, they have to work really hard to compete with the likes of Jubilant Foodworks, Westlife, etc. And Domino's, which is operated by Jubilant Foodworks, has around 1,350 stores all over India, whereas Burger King just has 261
Exactly.
stores. So it is nowhere near the scale that Domino's has, and even it's I think 100 or 150 stores lesser than what McDonald's has in India. So Also, in terms of market share, Domino's is the leader with 21% market share, followed by McDonald's and KFC, and Burger King is the sixth position with a 5% market share. So,
Exactly.
it's a long road ahead. And one point that I really like that you made was that the advertisement campaigns that these QSR chains have had, over the years, like Domino's with the 30-minute free ad campaign, and then meals that McDonald's have come with the innovative menus. I remember you telling me that they came out with a Mexican burger something. So, you know
Exactly.
again, Burger King has to constantly innovate. It has to constantly shuffle its menu. It has to come out with a marketing campaign that generates a level of excitement about its brand. People have to perceive it. People have to have that image. Like whenever someone says Burger King, the burger should be in your mind, and that should be a very tasty burger in your mind. And till now, in the 5 years that Burger King has been operational in India, I think the image is still not there. So to really establish its brand in India, it's going to take a lot of time, and even to break even, I think it's going to take the next 2-3 years at least for Burger King to, I think, conservatively, if we're talking, it's going to take time. So it's not going to be easy, especially with competition from the likes of Domino's and McDonald's. Also, to mention some other names, Subway is also a very big player, and the unit economics of Subway are amazing. So to compete in this fiercely competitive market, they have to constantly stay on their toes, and they have to constantly innovate. Otherwise, these bigger players are gonna grab that market share, and Burger King will be in trouble, I think, going forward. So our next parameter is financials. And what do you think? Are the numbers looking good?
So Siddharth, before going into the financials, I think so we should dig deep into the unit economics of these QSR players. So as you said, Domino's has the highest number of outlets at 1,354, followed by McDonald's. So Westlife Development have close to 311 outlets. Burger King has 261 outlets. Now the order value, that is the average ticket a customer spends, is similar when you compare Burger King, when you compare McDonald's, when you compare Domino's. But what is a striking point is the gross margins. Now these players have a very high gross margin. So Burger King has a gross margin of close to 64-65%. Westlife Development has around the same margin, which is at 64-66%. But Domino's has a gross margin of close to 77-78%, which is the highest among the
Wow,
QSR players.
that's a lot. That's a lot.
Exactly. So a pizza that you buy, the raw materials that go into it are only close to 21-23%.
Mm, yeah.
Another point that I would like to highlight is the capex that is required for these players to set up a shop. So Domino's requires the least amount of space to open an outlet, which is close to around 1,400 to 1,600. McDonald's has requires close to around 2,600 to 3,200, whereas Burger King has outlets which are comparatively smaller if you compare it with a burger chain like McDonald's at 1,300 to 1,400. So this kind of reduces the upfront cost that is required for these players to open a location, enter into a new location. But bear in mind, a major expense that these companies have is the royalty that they have to give to the foreign holding company. Now, McDonald's and Burger King have a royalty of around 5%. But bear in mind, Burger King has to pay an additional one time fee for every location that they open. And one of their mandatory objective is to open new locations.
Mm.
So they'll be spending a little bit more as one time fee on opening new locations. If you compare that with Domino's, so Jubilant has to pay only 3 to 4% as royalty to its foreign parent company.
So on that front, I think again Jubilant is better positioned. I think because I think with every store, royalty does make a difference, because it's a recurring revenue thing that you need to pay to the holding company. So again, I think on that front as well, Domino's is in front.
Agreed. So Domino's beats its peers hands down in the operating metrics and the unit economics. Moving on to the financial side of things, so Burger King has been able to achieve operational profitability, but it has not been profitable. So the PAT has always been negative. But what we would like to first focus on are the positives, that is the revenue has grown. So as the locations are keeping on increasing, the revenue has grown and it has shown a tremendous growth in the revenue. However, it has not translated into the bottom line. It is still running into losses. It has not been able to achieve a break even or become profitable, that is after 6 years entering into the Indian market. Another thing that I would like to highlight is the COVID impact and how these players have kind of coped up with it. So if you compare companies like Jubilant, for every company the dine-in had to be stopped. So they were kind of relying on the takeaway or the delivery side of things. Besides that, Jubilant has been able to achieve growth YOY as compared to last year. And how have they achieved that? They have achieved that by controlling the cost of their raw materials. So they have further increased their operating margins. So that is the benefit these established players have been able to achieve. Domino's, if you compare that with McDonald's, Westlife Development, they have also seen an uptick in their online delivery side of things. But if you compare that with Burger King, they were slaughtered and they were slaughtered badly due to COVID. So
Yeah.
COVID kind of hit them very badly. It hit them such hard that they kind of had to postpone and delay their target. They were supposed to open 700 locations by 2025. They had to delay it by a year
Oh yeah.
just because of COVID.
So I just I think COVID was really a big blow for the company. I think you also told me that the company was slowly shifting towards profitability, but because of COVID, the revenue again it was slaughtered and they were back in
Exactly.
red. Yeah.
It was very close to achieve profitability, but then COVID hit them and hit them hard.
Yeah. To give some numbers, I think for the 6 month ended 30th September 2020, the company had incurred a loss of 119 crore and revenues had declined by 68%. And they had to close down most of their stores during the first quarter. I think only 40-50 stores were operational in the first quarter and they gradually opened in the second
Exactly.
quarter. But the first quarter was it was very bad. And it shows you the reason why Burger King is not able to compete with the likes of Domino's and Westlife is because they don't have the supply chain management and the omni-channel presence that these companies have at that level. Because if you have 1,300 stores, you can do a lot of business even when things are not looking good. You can maneuver that crisis and you can work it out. So we've seen that. And also the problem of being in a food business is that your raw material is perishable. So when you close your stores,
Exactly.
just like Burger King did here, all the food inventory that was lying in the stores, that was perishable, and that also hit them hard. And
They actually had to write it off. So one of the main things that hit them was these perishable commodities because they had to write it off.
so yeah, I mean the raw material went bust. Also, if you think, the biggest risk going forward is the mandatory requirement to open new stores. So, like you said, Burger King has to achieve that 700 store count by 2026. What this means is that they have to incur a lot of capital expenditure each year. It does not matter if your company, if your business is not good, you still have to open that store. You still have to go out. You have to still, choose that location. Even if that location is not good, you still have to open it. So I think that's one of the biggest risks because the company is still making losses, and 119 crore is not a small amount, especially when you are at the capacity level of a Burger King brand. So, the only way that these guys could fund that growth in the long term is either through raising more capital or through bank loans. And, the books could suffer in the long run. If they open new stores and the new stores don't work out, then it's going to be really tough to just come out of that situation. And yeah,
And Siddharth, this is bound to happen. So it is not possible that every company has a 100% hit rate. So there are bound to be locations which are not performing great. So then it is the call of the company. How do they achieve the target of 700? Also, how do they make their business financially positive so that they kind of start generating profits? So that is where the management and their expertise is going to come into the picture.
definitely. I mean, if you're the management working at Burger King India, it's going to be a big headache for you. And it's going to show like the management quality as well. We've not covered that in great detail here, but management quality and the strength of the management will be reflected in the way they maneuver the situation. Because I think it's honestly, I think it's going to be very difficult given the situation that, not every store, like you said, is going to be successful. So there are going to be store closures as well. And Burger King is still at 261 stores at this point in time. So on a net basis, they have to open 70 stores each year. And I mean,
Exactly.
they have to be increasingly cautious about spending money, and they have to allocate capital in a very efficient way. So let's see how that goes. It's going to be a tricky ship to run. And coming to our next and the most important parameter, valuations. So, how does the stock look from a pricing perspective?
So, Siddharth, this is something which has kind of appealed to a lot of investors who have put in their money in the IPO. As we had discussed, the company is not able to generate profit. So, P in this situation is not going to be a correct measure. What we can do is compare the EBITDA margins. Burger King has an EBITDA margin of close to 12 to 13%, which is just a tad shy of what Westlife achieves, but is way behind what Jubilant achieves with its Domino's franchise. So on that front, Jubilant kind of takes the lead. If we compare the EV by EBITDA ratio, so this for Burger King is 29. That for Westlife Development is 34, and that for Jubilant is 38. So Burger King is comparatively cheap as compared to these peers. What
Hmm.
we can compare and use another financial metrics is EV by sales. For Burger King, it is 3.6. For Westlife, it is 4.8. And for Jubilant, it is high at 8.6. So
Hmm.
here, Burger King kind of gives a value proposition to the investors, and that is the response that they have given to its IPO. But I would like to highlight one point. As early as May 2020, they did a private placement to its parent company, and the value of the share of the company was 44 rupees. So the value at which the company is bringing in its IPO is in a price band of 59 to 60, and they have gone ahead with allotting shares to its promoter company at 44. So that is kind of being greedy in this bull market.
Yeah, I mean, it's been what, 7 months from May, and in that period of 7 months, I don't think a lot has changed. I think in those 7 months, the value would have gone down. I think
Exactly. COVID
so.
hit them hard. So
So I think, like you mentioned, they're just capitalizing on the insane run that the market is on right now. It does not make sense. It's not logical. I've been saying it every show, every week, and the markets still continue to go up. Like, it doesn't matter. It does not care for, whether the economy is in recession, whether the economy is contracting for 3 straight quarters. Doesn't matter. And I think that's why every company is looking to bring out its IPO in a, in this situation, because even with a valuation of, like, they're listing at 59 to 60, and just 7 months back they gave an issue to its own entity at 44 rupees a share. So even after that, they can afford to bring that IPO and probably be successful at it. So I do think that, people could probably take a look at the books before investing in Burger King. I also think, because the reason why Jubilant and not Westlife, but why Jubilant is able to command such premium in the market is because of the way it runs. Because on every count,
exactly.
on every metric that we have analyzed here, Jubilant is the clear winner. It has, the most market share. It has the highest gross margins in the industry. It has the highest store count in the Indian market. So that's one of the reasons why Jubilant is priced as such. And Burger King, although it's looking cheaper in comparison to its peers, but I do think it's justified. The reason why it's cheap is because it's nowhere near the scale that Westlife and Jubilant has. So just be on the watch out, I would say. So to just close it out, what would be your recommendation for people who have applied for the IPO and who are also looking to probably buy the stock after it lists on 14th of December? What would you tell those people?
So Siddharth, the response to the IPO has been great, or should I say, it is a whopping response. But
Yeah.
but we'll have to keep in mind that the company is yet to prove itself in the Indian market. So my recommendation for investors who kind of get allotment in the IPO is is to take the benefit of the tremendous gray market premium that is currently going on and to lock in their listing gains. And for new investors who are on the lookout, I would say just keep the stock on a watch list and kind of see how the company performs, because the company is yet to prove itself that it can sustain a profitable growth.
Definitely, because I think even if you look at the previous 3 years, it's still loss making. September quarter, September half year ended has not been kind to it. It's not been able to capitalize on the work from home thing that has caught on. So people were still ordering pizzas. Domino's was still doing good, but no one. I don't think a lot of people had ordered from Burger King because it was clearly evident from the sales. So they failed to capitalize on the online food delivery revival that took place in the second quarter. And I think for the people who get the allotment, like you said, book those profits, I would say. And for people who are looking to get in, new shareholders who didn't get the allotment but probably are the ones who buy stocks on the IPO date, probably just hold back, look for 2 or 3 quarterly results, see if the company can bounce back, how that store count is going up, are they able to open new stores, what is the capex flow that's happening. And just probably there are, I think, better stocks out there than Burger King which you can put your money in. So keep it on your watch list, and I would say just give it 1 year. And if Burger King can deliver on its promise, if it can generate that level of excitement, probably have a good marketing campaign, then the stock can go from your watch list to your buy list. But again, before doing anything, do your research. Don't take my word for it. And again, Rishabh, thank you for coming on the show. It was a pleasure having you. And I hope, because you are the guy I turn to whenever an IPO comes out. So the next time, probably we'll do a show before the allotment window closes. We'll try do that.
So that's a big responsibility on my shoulders. I'll try to keep up with it.
Definitely, definitely. I love having you on the show and your perspective. So be in touch. And that does it for today's edition of Bazaar. People on the show may have certain recommendations to buy or sell, but don't buy or sell based on what you hear. Do your own research before you take any investing decision. And let us know what you think of the show. You can reach out to us at thebazaarpodcast@gmail.com. If you have any topic suggestions, if there is any company that you want us to analyze, you can reach out to us. And that's it for this week. We'll